If you own rental property and generate paper losses through depreciation, the IRS restricts you from using those losses to offset your active W-2 income. However, specific provisions allow these losses to flow through and reduce your taxable salary to zero. This strategy relies on a specific classification called Real Estate Professional Status, or REPS. It is an IRS designation under Section 469 that permits taxpayers to treat rental activities as active businesses rather than passive investments. To achieve this status, you must meet a specific annual requirement. You have to perform at least 750 hours of personal service in real property trades or businesses within a single calendar year. While 15 hours a week sounds achievable for a dedicated owner, the IRS employs a rigid set of definitions to classify those hours. If you fail to categorize your time correctly, the designation and the tax deduction can be stripped away. Claiming real estate professional status signals the IRS to look closer at your return. During an audit, agents will dissect your yearly calendar to verify that every logged hour meets their strict criteria for active participation. To understand how to protect your status, we are going to audit a hypothetical investor's timesheet. We need to identify which activities the IRS counts and which ones they discard as invalid. Most investors lose their deductions not because they were idle, but because they documented the wrong categories of work. We begin with red light hours, tasks the IRS rejects as passive or personal. This includes investor time, like scrolling Zillow or reading market reports. It also includes delegated time, when a property manager handles repairs, and the personal commute to your rental properties. If your log relies on research, delegation, and travel to hit your target, an auditor will systematically erase those entries until your qualifying total collapses. Beyond these categories, many owners believe that simply being on call for tenant emergencies satisfies the requirements. The reality was established in the Moss Tax Court case. Mr. Moss worked 1,900 hours a year as a technician at a nuclear power plant while managing several rental properties on the side. With only 645 hours of physical labor, Moss argued he was participating whenever he was on call for tenant emergencies. The court rejected this, ruling that being available is not working. Services must be actively, physically performed to count towards the 750-hour threshold. This ruling means standby time yields 0 credit. The IRS requires actual performance of operational tasks. To reach 750 hours, focus on green light hours, hands-on tasks meeting the IRS definition. This includes personally screening applicants, drafting leases, and responding to maintenance calls. You can also count sweat equity, like physical repairs, staging units, supervising contractors, and property bookkeeping. But even 750 hours of valid work won't save you if you failed the secondary requirement, the 50% rule. Your real estate hours must exceed all of your other working hours combined. If you work a standard 2,000-hour job, you would need to log at least 2,001 hours of real estate activity to qualify. This math makes the status nearly impossible for full-time W-2 employees to defend. The designation is structurally intended for those whose primary professional focus is their property portfolio. If you genuinely work the required hours, you still face a final hurdle. Legitimate real estate professionals lose their tax deductions every year simply because of how they kept their records. The fatal mistake is the ballpark guesstimate. This occurs when an owner tries to reconstruct their entire year of maintenance runs and tenant calls from memory just before filing their taxes. The IRS mandates contemporaneous logging, meaning you must record the work as it happens. A log created months after the fact holds almost no weight in court. In the eyes of an auditor, an undocumented hour is an hour that never existed, regardless of the physical effort you actually expended. A compliant time log doesn't require complex software, but it requires consistency. You are building a daily record of evidence. Every entry needs 4 mandatory data points: the date, the specific property address, a description of the task, and the exact duration. You then verify that log with external records. An entry for a maintenance run becomes bulletproof when you compare it with a dated receipt for materials purchased at the same time. The real estate professional status is earned through meticulous documentation, not only the physical effort of property management.